Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, it's time to eat some humble pie because our call for the show was entirely wrong last week, and that was a Hillary Clinton victory. But more so, it was what might happen if Trump did win, and the opposite basically happened in the market.
That's right. It's been an incredibly surprising week. And we did sit here last week and say the likelihood was that Hillary Clinton was going to win. I mean, that's what the polls said, and that's what the markets were pricing in. And I mean, we weren't exactly going out on a limb in that respect. It was fairly common opinion. Anyway, as we know, fast forward 1 week and Donald Trump did win. And we sat here last week and said, well, in the event that he wins, what's going to happen? And we laid out a couple of scenarios. And in the end, it's gone completely the opposite, pretty much, to what we expected. Everyone thought that there would be carnage in the markets following a Trump victory. And there hasn't been. I mean, there was weakness on that Wednesday morning when it became evident that he was going to win. But it didn't last.
Yeah,
it was a fleeting couple of hours. Yeah, fleeting couple of hours of market weakness and a little bit of turbulence. And ever since then, it's suddenly, you know, the markets have done 180 degrees about turn. And now everyone, it seems, quite likes the idea of Donald Trump being the next US president. So, I mean, I don't know. Maybe it's just that the uncertainty's been removed now. And we know what we're dealing with.
Or maybe it's just, you know, maybe it's also the Trumpflation trade, which has gripped everyone's imagination, is at the forefront of what is happening to the market, the sell-off in bonds, and the expectation that, I guess, equities are going to do well. Garth, you've got a chart of the S&P 500 up there, so maybe kick us off with that this evening. Yeah,
we're going to basically look at the charts that most of the charts that we looked at last week, and then just sort of update them with a view, and I'll say what I thought was going to happen and what did happen. I always like to be held accountable on the show. We all make mistakes, so I'll show you where we got it wrong, and you know, it keeps us honest, I suppose. So we're starting the week with a look at the S&P 500, which we usually do. And last week we sat here and the market was down. It was sort of testing this 200-day moving average. It had bounced up a little bit off that level. But I said at that stage that if Donald Trump did win, the likelihood is that it was probably going to see a sharp move to the downside. And obviously he won, and we didn't see a sharp move to the downside. We saw a sharp move to the upside. But having said that, what's not reflected on this chart over here is the fact that in the early morning, and I talk our time, 5 a.m., 6 a.m., the S&P 500 futures were trading down at 2040. So just to give you an idea, that's where my mouse cursor is pointing over there right now. It's well below the 200-day moving average. That's where the S&P 500 futures were pricing the market at that stage. And obviously later in the afternoon, by the time the actual S&P 500 equity market came online, by then the markets had begun to sort of see Trump in a more positive light, and we saw this enormous rally. And what's happened subsequently is that it's actually now pushed out through the top of this resistance, which is at about 2060, and we've pushed out through that level now. So it looks from here like we had this false break to the downside, and which has resulted in a nice snap back push in the opposite direction to actually make a break out the top now. Now the question from here is, does this break have follow through? Will it continue to the upside, or is it going to be another sort of false break where it fizzles out? Difficult to say, but the markets for now seem to feel like they have a bit of a bid under them. Certainly the US market does anyway.
And what about the VIX? Because we spoke about that last week as well. And it has been very active, and it spikes up, but it's come all the way back down again.
That's right. So, I mean, if you look at this VIX chart, the VIX, just to reiterate, is a measure of volatility. It's an index that tracks implied volatility on S&P 500 options. So when you get the VIX moving higher, that generally implies a market that's somewhat fearful. It means that it becomes more expensive, essentially, to buy protection on options on the S&P 500. And what we saw before the election was that there was a time when it looked like Trump was closing in on Hillary Clinton, and you saw the VIX spiking. Last week I mentioned that it had rallied like 75% or something in 9 days. And then it started to look like Hillary was going to win, so the VIX came off a little bit. And then when Donald Trump did win, you had this enormous move to the downside in the VIX. So instead of it spiking out and going significantly higher like we thought was going to happen, the opposite happened. The VIX actually came all the way back down, and the market seemed quite content with that. So again, a totally opposite reaction in the market to what we would have actually expected.
And then if we take it back home, well, before we do though, the gold price has been very interesting. And Now, there was expectation that if Trump won, the gold price would spike. Yeah. And it has done exactly the opposite. So, completely. I mean, as in keeping with the theme of doing the opposite of what was expected, the gold price has sunk. Yeah. There seem to be some other factors there related to India, but what is your view on this, Garth?
Yeah, well, so I mean, what happened with the gold price and what we discussed last week was the fact that the gold price had been testing this 1,310 resistance. And you can see that's a significant level. Notice all the lows there through July, August, and September. It broke down in September, then rallied up to retest the underside of that resistance, and then it began to move lower as we approached the election last week. And I said last week that if Trump were to win, the likelihood is that we would break above this 1,310 and go significantly higher. And I basically made the point. I said anything, a Trump win effectively means the gold price should be above this resistance line, and a Hillary Clinton win, likely the gold price will be below the line. Well, again, notice for a while, maybe for 2 or 3 hours, the gold price did spike up. It got up as high as about 1335, and that was pretty much the high. And then you can see a very, very violent sell-off from there on. It fell from 1335 all the way down to 1270 on the same day, and since then it's just continued to go lower and lower. And if you look at that in four trading days, the gold price has fallen $130 from the time when Donald Trump won. So again, totally unexpected. I mean, I think it was Credit Suisse that was saying that in their research they said, if Trump wins, gold price is going to $1,400 an ounce. Well, that didn't happen.
So
at least I was in good company, I suppose. But I mean, it's kind of come about on the fact that the dollar has strengthened following the Trump win, and that's been negative for the gold price. And I see big investors. George Soros has begun to liquidate his gold exposure and what have you. So you see heavy selling. And you can see it in the volume here as well. Notice the volume at the bottom of that chart, how elevated it has been over the last 4 days or so.
And I've seen some reports suggesting, and I'm not sure how to link them in my mind, but the decision by Narendra Modi, the Indian Prime Minister, to ban 500 and 1,000 rupee notes is going to take a lot of cash out of circulation, out of the Indian economy. And those notes would have been used to buy physical metal like gold. And it was kind of a way, I guess, of washing that money. And that trade might not happen, which is also apparently one of the reasons behind the drop in the gold price.
It could be. It's all very, very interesting. I mean, you can see all of these moves are aggressive in the way they've happened, and notice again the volume. So it's a possibility that maybe adds to the reason, yeah.
And the rand-dollar exchange rates, because that's the next, I suppose, ratio or I guess market indicator that we looked at. This hasn't gone in our favor at all.
It hasn't, no. So what we spoke about last week was the fact that the rand-dollar exchange rate has been trading in this downward sloping channel the whole of this year. That's basically the year-to-date trading action that you can see there. And what I'd said is that we have this triangle structure, which is indicated by those green lines over there. And there was a perfect triangle continuation pattern forming there with 4 waves, and it had begun the 5th wave, and it had started to break below the bottom of that triangle structure. And from a technical standpoint, that generally points to a move. You take the height of that triangle at its broadest point, and you take that and project it down. That'll give you your target. And we were looking at a target down between 12 Rand and 12 Rand 50 for the rand-dollar exchange rate. And it looked fairly convincing. But what's happened since then is the rand has done a massive about turn. And it has come about partially on the fact that the dollar has strengthened after the Trump victory, but also it seems like there's been quite an aversion away from emerging markets assets. And if you look at other emerging market currencies, they've suffered a similar fate to the rand. The rand is 8% weaker since Donald Trump won the US election, to give you an idea. So it's an unexpected turn of events there as well. And if you look at some of the trading action in some of our stocks, look at Naspers, for example. It's a very heavily weighted stock in the MSCI South Africa index. Naspers has been under an enormous amount of pressure, notwithstanding the weaker rand. So all of this, to me, suggests that there's an exodus out of emerging markets, and you're seeing emerging market bonds being sold, you're seeing emerging market equities being sold, and of course then emerging market currencies being sold in order to repatriate that money back into dollars or wherever it's come from. And that's what you're seeing in the rand-dollar exchange rate here. That's very sudden weakening of the rand, which to me it looks classic like an emerging market exodus.
Well, then how's that reflecting in the chart of the top 40?
Well, this is interesting. So ordinarily you would expect that a weaker rand should translate into a move higher for the top 40, and it actually hasn't. This is where it gets interesting, and it's because of stocks, for example, Naspers, that have come under a lot of pressure, and others as well. British American Tobacco has. So there are a couple in our market, but it's a disconnect, because usually a weaker rand should actually be helping the top 40 higher, and hasn't in this case. If we look at our top 40, it's clear that there's still this pattern of falling highs over here. What happened last week was that the market reversed off the underside of the 50-day moving average, which you can see quite clearly over there, and it's begun to turn to the downside. And right now, the market's weak again today. It looks as if we might be headed back towards 43,000 in the near term to retest the low that we saw on the morning when Donald Trump had won the election.
I mean, maybe it's, and I know that you want to have a bigger picture look at the top 40, but it's, I suppose there's two questions. Do you challenge now all your assumptions of the market? Have they all been thrown into question by the events of the past weekend? Also, have we been maybe too simplistic in the way we look at things? So weak rand equals good for rand hedges, good for Naspers, ergo good for the market. But the Trump factor means there are going to be trade issues with China, and maybe that's what's affecting Naspers. And we have to be a little bit more sophisticated in the way we look at things.
Yeah, definitely you need to look beyond the obvious, I think, and that's what this last week has shown us. Because clearly what we thought was obvious definitely didn't happen. So you do need to change your thinking a little bit. But I think also it comes back to the thing, you've got to just trade the market that you see. And if the market that we see is not what we thought it was, don't always go along with what you thought. Trade what you see. But to that end, I think what I am pleased about, although all of my assumptions might have been wrong about what would happen in the event of a Trump victory, what we did get right was, I said last week, it's too uncertain to be making any trades in this kind of environment. I'd rather stay out. The way we are positioned for our portfolio is that we've got this bearish option structure, and against that we've got 5 all-me futures that we are long of. And that effectively gives us benefit of both ways. And you can see it illustrated on this chart of the top 40 over here, where that green diagram on the right-hand side effectively illustrates the payoff that we have of this option structure. And right now, where we're sitting is actually in quite a good place. And you can see that red line there indicates approximately where the market is at the moment. And we're sitting with a total profit of this structure of just over 15,000 Rand in mark-to-market terms. So I think, although we didn't call it right, we were positioned well. And we've actually made money this week, notwithstanding the fact that we called it all wrong.
Yeah, and making money by doing nothing, although these options were sort of built into the portfolio a couple of months ago in order to give you flexibility. If the market does look as if it's heading weaker still, would you take out maybe more exposure to a falling market? Would you build on that structure that gives you participation if the market falls further?
I wouldn't at this stage, and the reason being that we're now quite close to the futures closeout for December. It's a month away, and with these type of structures, you need to sell out the money puts and buy near to the money puts. And the trouble with doing it so close to the expiry now is that there's not enough time value left. When you're selling puts short, you don't get paid very well to sell out the money put option. So I wouldn't do it at this stage. When we did it, which was about 2-3 months ago, obviously the time value factor was very different then, and that played into our hands. So I wouldn't add to the structure. Now, I'm very happy with the way it is, and I'm very happy to leave it like it is and let the market do its thing.
Okay. And let's show people, maybe very quickly before we get to that.
The last thing before we get onto the portfolio quickly is I just want to look at this. Now, this is a much bigger picture chart of the top 40. It's a weekly graph, so every candlestick pattern here represents 1 week worth of trade. And it's really just to point out the fact that this is our market. For the last nearly 3 years, you can see it's been going sideways in this range between 41,500 and 49,000. This year, that 45,000 level was significant. We've broken convincingly below 45,000, and we seem to be well established below that level. To me, when I look at this chart and I just eyeball it, I think there's still a fairly reasonable chance we're going to come to the bottom of this broader range, down towards 42,000 or so.
Garth, and then to wrap up very quickly, what the portfolio looks like in next course dates.
So the portfolio, as I said, we've still just got this option structure and the 5 all-me futures that we long. We've got nearly 310,000 Rand in the portfolio, so we are at a new high for the year, which is great news, notwithstanding the fact that I got some of my assumptions wrong about Trump. Then courses, I'm busy this week. I've got a course in Johannesburg on the 19th of November, this Saturday, and in Cape Town on the 26th of November. If you want to attend, please email me, garth@traderscorner.co.za for details.
Okay, Garth, we have to leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.